Welcome to the PAI Morning Briefing. I'm your host from Pantheon AI, and today is March 7th, 2025. Good morning, everyone. I'm excited to have you with me as we dive into the markets, explore significant trends, and discuss some of the stories shaping our financial world today. Grab your coffee, settle in, and let's get started.
Let's begin with a quick market overview. Today, the S&P 500 is trading at roughly 5,738.5, reflecting a decrease of about 0.8%. The Dow Jones is around 42,579, down roughly 0.6%, and the Nasdaq is sitting at about 18,069, down a similar margin of 0.7%. Over in the small cap arena, the Russell 2000 is at roughly 2,066, down about 0.7%. In the world of cryptocurrencies, Bitcoin is trading at about 89,447, down slightly by just over 0.5%, while Ethereum is around 2,195, down by approximately 0.3%.
It seems like the major indices and digital currencies are having a bit of a challenging day, suggesting that the market is embracing a cautious note in the early hours.
Now, when we take a deep breath and look at the broader trends, there's a clear narrative emerging across various segments of the market. First off, the cautious sentiment among major indices could be a reaction to a mix of periodic profit-taking and global uncertainties. Sometimes it feels like investors are comparing themselves to a chef tasting a stew and finding it just a little too salty, wondering if they might have overseasoned when the market's expectations have shifted. That oversight, however, might also reveal an opportunity lurking beneath the surface.
One of the headline news stories making waves today involves Nasdaq's ambitious proposal. In a bold move announced on Friday, Nasdaq Inc. plans to launch a platform that will allow stocks to be traded over a 24-hour period from Monday through Friday. Now, this is a fascinating development as it challenges the traditional market hours and might redefine how liquidity is managed in a globally connected economy. Imagine a marketplace that truly never sleeps. It could provide more flexibility for investors from all corners of the globe. At the same time, it raises questions regarding market volatility and risk management. Will the extended hours lead to more erratic price movements, or could it offer a smoothing effect by dispersing liquidity demands? I find myself wondering, have we seen anything quite like this before? Well, not on this scale, so it's a bold leap forward for one of our major exchanges.
Closely tied to changes on Nasdaq, there's chatter about an impending reshuffle within the S&P 500. Several companies, including Coinbase, AppLovin, and Block, are in the spotlight as top candidates for inclusion in the index's next iteration. This potential reshuffle is not just an administrative exercise. It could signal a shift in market sentiment where technology and Fintech continue to gain prominence. It's like watching a sports team revamp its roster in hopes of tapping into new talent. And a fresh strategy, investors are naturally curious whether these companies will drive further innovation or if they'll simply emerge as symbols of changing regulatory or market trends.
Now, taking a look at the energy sector, oil prices seem to be dancing on a tightrope. After a bounce that has provided some temporary support, the market is now looking at weekly losses amid concerns of tariff-led disruptions. The catalyst here appears to be comments made by Russia's deputy prime minister, who indicated that OPEC Plus might reverse its decision to increase production next month if the market appears unbalanced. So while oil prices have managed to find some footing, the underlying uncertainty remains palpable. And if you think that oil's performance is as unpredictable as trying to predict the weather in spring, you wouldn't be too far off.
On another intriguing note, there's a piece drawing comparisons between America's current job market and the eerily reminiscent conditions of the 90s dot-com boom. While the dot-com bust is now a distant memory and certainly a cautionary tale, the conversation today isn't solely about doom and gloom, rather. It's an invitation to analyze whether today's job market is on the brink of a similar correction or if the lessons learned from past decades have guided us into a more grounded, sustainable economic cycle. It's a bit like looking into a crystal ball that shows both promise and peril, and it definitely sparks some interesting debate among market watchers.
Now that we've set the stage, let's delve deeper into these stories and unpack some of the layers behind these market shifts. Starting with Nasdaq's 24-hour trading plan, what does it really mean for the future? On one hand, round-the-clock trading could represent a major breakthrough, potentially increasing market efficiency and offering investors more flexibility. For instance, international investors could react to global events outside the traditional U.S. market hours without having to worry about time zone constraints. However, extended trading also carries the risk of increased volatility and lower liquidity during off-peak hours. The consolidation of market activity into fewer hours might drive sharp price movements when markets do transition.
This move by Nasdaq is reminiscent of the early days of electronic trading, when the shift from open outcry to algorithm-driven platforms sent shockwaves through market structures. Today, as we entertain the idea of continuous trading, one must wonder, are we simply stepping into the next phase of evolution in market efficiency, or could we inadvertently be opening a Pandora's box of unforeseen challenges? While some seasoned traders might quip that if you can't handle the heat, get out of the trading room, the reality is far more nuanced. The convergence of technology and market operations demands that both regulators and market participants remain vigilant, ensuring that any potential chaos is preemptively managed with robust risk controls.
Switching gears, let's turn our attention to the anticipated reshuffle of the S&P 500. With Coinbase, AppLovin, and Block emerging as notable candidates, this isn't merely about index composition, it's about the evolving zeitgeist of the market. These companies are emblematic of a new era where digital currencies, app-based economies, and blockchain technology are increasingly interwoven into the fabric of everyday business. For investors, this reshuffle raises an important question. Are you positioned to benefit from what could be a significant structural change in market dynamics? Inclusion in the S&P 500 often attracts additional institutional investments as index funds flow in, which can in turn drive up share prices. However, this also means increased scrutiny and pressure to perform consistently in a competitive landscape. So while these companies may boast impressive growth figures and innovative products, subsequent volatility cannot be entirely discounted.
Next, we examine the energy sector's delicate dance with oil prices. Oil futures have seen a rebound, but the shadow of potential weekly losses looms large due to tariff fears and geopolitical signals. The comments by Russia's deputy prime minister add a layer of complexity. If the decision on production levels is reversed, it may suggest that the market is more sensitive to balance and supply than what many anticipated. For those trading commodities or relying on energy derivatives, this is a head-scratcher. It's akin to watching a tightrope walker. One misstep and the entire balance can tip dramatically. Of course, skeletal jokes aside, energy markets are notoriously cyclical, and understanding the interplay between geopolitical events and market sentiment is key for long-term investors.
This scenario pushes us to think, are we going to witness a period of recalibration in energy prices? Or will these fluctuations simply be a blip on the radar of a much larger, steady upward trend in global demand?
Then there's the fascinating discourse on America's current job market. The headlines have drawn comparisons with the dot-com boom of the 90s, a time marked by exuberant enthusiasm wrapped in the inevitable burst of a bubble. Now, as we examine labor market trends through modern lenses of technology integration and remote work, there's an underlying question. Are we in the midst of a similar overheated boom, or have modern safeguards and more diversified economic sectors dampened the risk of a catastrophic correction? It's a conversation that's both reassuring and cautionary. While innovation often leads to rapid growth and occasionally an unsustainable pace, robust regulatory frameworks and broader market participation might well be acting as buffers against such extremes. It's a topic that deserves our scrutiny, inviting each one of you, our thoughtful investors, to question where we see potential growth and where caution might be more apt.
Let's take a moment to break down these developments across different sectors. In the technology sphere, Nasdaq's initiative and the prospective S&P 500 reshuffle highlight that innovation isn't just a buzzword, it's a defining factor of market evolution. Companies like Coinbase, AppLovin, and Block embody the spirit of disruption that has characterized recent technological progress. The potential for increased global participation in trading, as facilitated by round-the-clock markets, might very well be the catalyst for greater technological integration in how trading and financial operations are managed. If technology continues to break down traditional barriers, could we soon see a world where trading is not restricted by geography or time zones? The possibilities are intriguing, and they certainly invite further debate.
In the realm of energy, the situation with oil prices is a classic study in market sentiment influenced by geopolitics. The interplay of tariff fears, production policies, and supply-demand fluctuations can create an environment where traders must be nimble. One might say that investing in energy these days is a bit like trying to predict the next twist in a thriller novel. You know there's a surprise around the corner, and only time will reveal the true direction. As futures rebound after a dip, the broader implication for sectors reliant on energy costs like transportation and manufacturing remains a significant concern. It brings to mind a humorous analogy. Sometimes the oil market makes you feel like you're riding a carnival coaster, complete with unexpected twists and sudden drops.
The financial sector itself, while not as volatile as tech or energy in some respects, is not immune to these market shifts. With global economic uncertainties mingling with domestic policy changes, banks and financial institutions must navigate regulatory pressures while attempting to innovate in an increasingly digital environment. Whether it's through enhanced risk management strategies or integrating fintech solutions into traditional banking operations, the financial sector is undergoing its own internal restructuring. As more companies contemplate major index reshuffles and policy shifts, it could very well be that we see a transformation in how traditional finance competes with new-age digital platforms.
Looking at the broader global implications, these market trends extend far beyond the confines of the United States. International markets are closely linked with the intelligence emerging from major exchanges and regulatory decisions. The potential for extended Nasdaq trading hours means that markets overseas will likely adjust their strategies, seeking to leverage this new round-the-clock access. Similarly, any significant shift in oil production policies by key decision-makers could ripple through emerging markets that depend heavily on energy imports. The interconnected nature of today's financial ecosystems reminds us that a change in one corner of the globe can have far-reaching impacts on investment decisions worldwide.
Expert insights and predictions suggest that the coming weeks may test the adaptability of both established financial institutions and agile tech companies. Some analysts are bullish on extended market hours, predicting that increased liquidity could, over time, reduce the short-term volatility that many fear. Others, however, remain cautious, warning that the initial phase of such a drastic change could be fraught with risk. It's a bit like trying a new recipe. Sometimes you get a gourmet meal, and other times you're left wondering what went wrong with the seasoning. This natural friction between innovation and caution is likely to be the story of the next few months.
I like to think about these scenarios in terms of a friendly debate over lunch. On one side are the optimists who see round-the-clock trading as a symbol of our collective progress, and on the other are those who predict that if markets stretch themselves too thin, we might face increasing instability. As always, our role as investors is to balance our portfolios accordingly, hedging our bets while keeping an eye on emerging trends. Are we witnessing the birth of a more fluid, integrated global market, or are we setting the stage for a future replete with heightened risk? That is the million-dollar or perhaps the 24-hour question.
Before we close out this segment, let's recap some of these stories with a bit more detail. To summarize, there are 4 major headlines we've been tracking today. The repeated announcements that Nasdaq is embracing 24-hour trading have been making waves in the market. 3 times over, the narrative has underscored the significant potential and the accompanying uncertainties of such a transformative move. Then we have the recurring emphasis on an upcoming reshuffle of the S&P 500, with companies like Coinbase, AppLovin, and Block emerging repeatedly as top candidates for inclusion. Each time the story has been mentioned, it reinforces the idea that our economy is evolving, with tech and fintech sectors playing increasingly influential roles. Then there's the story on oil prices, which, like a persistent subplot in a long-running series, has been highlighted repeatedly as it bounces back on the strength of supply-demand recalibrations amidst geopolitical uncertainties.
Lastly, the reflective piece on America's job market draws parallels to the dot-com boom, inviting us to examine whether we are on the brink of a similar cycle or if modern safeguards have indeed tempered the excesses of the past.
Let's now pivot to the sector analysis. In technology, the story behind Nasdaq's round-the-clock trading initiative appears to be a harbinger of significant change. This isn't merely a technical update, it signifies that the sector is unafraid to push boundaries. Investors should consider the potential ripple effects, particularly for companies that stand to benefit from increased trading activity. In contrast, for sectors like finance, which are still grappling with digitization amidst legacy systems, this development might serve as both a challenge and an opportunity. Financial institutions will need to invest in better risk management infrastructures, and perhaps we'll see a new wave of merger and acquisition activity as companies strive to integrate these technologies seamlessly.
In the energy sphere, oil continues to be the poster child for geopolitical and economic interplay. With oil futures currently embracing modest gains, albeit with caution over potential weekly losses, companies in the energy segment are watching developments with bated breath. The broader market implications are significant. Energy prices affect everything from transportation to manufacturing, and any significant volatility could impact inflation dynamics and consumer spending trends globally. As investors, one might ask, should we reallocate a portion of our portfolios towards energy derivatives, or perhaps hedge against the uncertainties by diversifying further into renewable energy, which may offer a more sustainable growth trajectory.
The financial sector, while traditionally known for its resilience, is in a state of flux. Expanding on the earlier points, banks are now expected to bolster their digital transformation efforts to keep pace with fintech innovations. This sector might witness increased collaborations or even friendly rivalries, reminiscent of a friendly game of chess, where both sides are strategizing for the long term. On that note, it's always interesting to think about whether traditional banks will adapt quickly enough, or if the technological wizards behind fintech innovations will eventually dominate the financial landscape. It's a classic David and Goliath scenario, but with a modern twist where both players are more tech-savvy than ever before.
The global market implications of these developments extend beyond just regional borders. As U.S. markets consider extended trading hours, global players are likely to recalibrate their trading hours and strategies to sync with this new paradigm. International investors might welcome the enhanced liquidity and improved access to U.S. equities for a longer duration. Conversely, there's the potential that extended hours might lead to greater divergence between market sentiment in different regions, raising the question of whether this could cause disjointed global market movements. Additionally, as energy prices continue to sway under the influence of geopolitics, emerging markets that are heavily dependent on oil imports or exports could face increased volatility. It's an interconnected world, and what happens in one market has the power to set off a chain reaction tens of thousands of miles away.
Throughout these discussions, one of my favorite parts is pondering the interplay of risk and opportunity. When markets are in flux, it's the perfect time for investors to revisit their strategies. Are you diversifying just enough to cushion against unexpected downturns? Or are you leaning into certain sectors with the hope that these emerging trends will yield exponential growth? These are the kinds of questions we ponder, much like when deciding whether one should eat that extra slice of pizza. Always a risk versus reward scenario.
Before wrapping up, let's touch on the expert insights and predictions for the near future. Many seasoned analysts agree that the evolution of trading mechanisms, whether through round-the-clock trading on Nasdaq or dynamic index reshuffles, is a reflection of the rapid pace of innovation in our industry. It's a reminder that we're living in an era where disruption is not just possible, it's inevitable. I've seen countless market cycles, and while history has its lessons, it also shows that periods of change are often followed by substantial growth. Think back to the early days of the internet. What started as a novelty quickly became a mainstay of the global economy.
Looking ahead, it might be helpful to consider a couple of potential scenarios. On one hand, if markets adapt well to these new trading hours with robust risk management protocols in place, extended hours could lead to heightened market efficiency and create new investment opportunities. On the other hand, if the integration is too abrupt or inadequate, we might see heightened volatility and segmentation between traditional trading hours and after-hours trading. The coming months will undoubtedly provide further insights as these changes are put to the test. For now, the best advice is to stay informed, keep an open mind, and, as always, diversify wisely.
As we wrap up our discussion, I want to extend a heartfelt thanks to Pantheon AI, your information co-pilot, in providing all these insights that enable us to navigate this complex market landscape together. In our daily pursuit of market clarity, we must remember that the landscape is always in flux, and the importance of adapting our strategies cannot be overstated.
Before I sign off, I have a few thought-provoking questions for all of you tuning in today. How do you believe round-the-clock trading might reshape the investor experience? Do you foresee the S&P 500 reshuffle as a major catalyst for market movement? Or do you think the incremental changes will be absorbed gradually over time? And in the context of energy, with oil prices showing signs of both strength and vulnerability, how are you positioning your portfolios to handle potential volatility?
Investing might sometimes seem as unpredictable as the punchline to a well-timed joke, but it's this very unpredictability that keeps things interesting. After all, if markets were predictable, maybe they'd be as dull as a tax seminar. Nonetheless, our role as thoughtful investors is to leverage these insights, remain agile, and find humor in the little quirks along the way.
To summarize the key takeaways from today's briefing, first, major market indices are experiencing slight losses, suggesting cautious sentiment amid a mix of profit-taking and global uncertainties. Second, Nasdaq's plan to introduce 24-hour trading from Monday through Friday is a bold move that may well redefine liquidity and trading dynamics. Third, the prospective reshuffle of the S&P 500 with companies like Coinbase, AppLovin, and Block under the lens signals that innovation in tech and fintech is an unstoppable force driving market evolution. Fourth, in the energy sector, oil prices are battling against the dual forces of supply-demand recalibration and tariff fears, while the broader global implications remind us of the interconnected nature of today's markets. And finally, with comparisons being drawn between today's job market and the 90s dot-com boom, we are encouraged to stay vigilant and balanced in our long-term outlook.
I encourage each of you to mull over these insights, stack them against your own market views, and, as always, feel free to reach out with your questions. Our AI co-pilot is here to help. Learning shouldn't feel like a full-time job, and neither should understanding the markets. We're all in this together, seeking clarity and complexity, and a little bit of humor along the way.
Thank you for joining me on this PAI Morning Briefing. Remember to come back for the next episode tomorrow, and please don't hesitate to ask questions, share your insights, or simply enjoy a little market banter with our AI co-pilot. Until next time, keep those eyes on the trends, your portfolios diversified, and your spirits high.
And always remember, learning shouldn't feel like a full-time job. Stay curious, stay engaged, and have a fantastic day ahead.